Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, July 13, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And as you can see today, we had another up day, very light volume. Today's shares or volume was about 35 million shares, settle out slightly more than that, but that's basically, one of the lighter volume days of the year. Not quite the lowest, but it's very light, and that tells you that the market was, or it tells me that the market was basically waiting on the bank earnings, which are going to begin tomorrow morning, and that's going to kick off earnings season, and that's going to be a tell of what's to come over the next several weeks. So tomorrow, I believe you have JP Morgan for sure, Wells Fargo, PNC, and Citigroup. So that's going to lead the charge tomorrow one way or the other. Maybe we get a spike higher. Maybe we get a sell-off. Who knows? On Friday, it's in a bull market on Fridays, and you'll notice this over the last few years, it's very unlikely you get a big down day on Friday. That's not generally what happens. So we could get some volatility, or we should get some volatility in the morning. The banks report earnings early. They report earnings long before the market opens. So whatever the direction is when you take a look in the morning, that's likely as a result of the bank earnings. So we'll see what happens. Maybe we get a spike higher. We could make new highs. We'll see how that all plays out. There's just no way to predict exactly which way or how the market's going to interpret what the banks say. And that's why we don't trade earnings, because it's a crapshoot. It's a flip of a coin. You could predict that banks are going to have good earnings, but that doesn't mean the market's going to react positive, and vice versa. It's just a coin toss. So back to the SPDR, back to the market. We're approaching the all-time highs. It's interesting. It's a very bullish market, especially in light volume. The path of least resistance is always higher in light volume, and that's what we saw today. We saw a little bit of a pullback in the middle of the day or in the early afternoon, one in the morning, one in the early afternoon, and each and every time the market recovered and was trending towards the highs, and we finished near the high today. So there's nothing wrong with this market. As I've been saying, there's no change from what I said over the last few days. The SPDR was up 34 cents. There's not much we could say about that, and nothing else materially has changed from what I've been saying for the last several days. So with that being said, let's go over to the IWM and we'll move along. Same deal with the IWM. It was up fractionally today, although I have to tell you that in the early part of the day, the IWM was the weaker index. And if you look at the 10-minute chart, for example, you'll see here that the IWM was selling, tried to fill this gap down here in from the 12th, from yesterday, didn't quite get there, and then it took off to the upside and trended higher in the afternoon session. So I thought that was interesting nonetheless, but there's not enough of a divergence, there's not enough volume, there's not enough movement in these indexes today to draw a conclusion one way or the other. That's just the way it is. We have to take what the market gives us, A, for investing and trading purposes, and B, for what I have to talk about. I can't make up a whole plethora of things when nothing happened. The IWM was up 12 cents. Nothing changed from yesterday, from what I've given you guys and what I think in terms of the cycle. Today was the day that I believe begins the cycle top, and it doesn't have to turn today. It's just today is the beginning phase of when I believe we are due for a turn in the market. And it could take another few weeks, but today's really the day that my antennas are clearly up, firmly up. I'm watching, I'm waiting, and any kind of sign that the market wants to give us, I'm generally going to pick up on it, so we'll talk about it here. So with that, let's move it along and go over to the transports. And the transports were down a few points today, but nothing material, same as all the other markets. Transports, you can make a case, make an argument that the transports put in a doji candle, but if that was the case, and it may be, I would have liked to seen it gone a little bit higher, and I would have liked to see a little bit more volume. It was above the average daily volume, about 57 million shares in the transports. That's not bad. It is a doji candle, and we'll just take that for what it's worth. I'm not 100% sure that's going to be meaningful one way or the other. I'm going to take my cue with more of a more movement, more activity, more volume, more interest in the market. Today was basically a lackluster day, so we're going to have to leave it at that. And it's very difficult to draw a conclusion from today, so we'll just move it along. And everything that I said over the last few days just remains true. I mean, when you look at the transports, there's nothing wrong with this market. The market's above the moving averages. The moving averages are sloping up, meaning uptrending. That means the market is uptrending. That means the maximum move that the market can have before it runs into significant resistance. And there is no resistance, technically speaking, since we're at highs. And when you look at the monthly chart, you can see here that we're at highs, and it looks like the market wants to break out on a monthly chart, right? That's what it looks like to me. Looks like we consolidated for a while, put in a couple of tail candles, a couple of doji candles, a big up candle last month, and here we are again at new highs, above the old highs. That's just a bullish market. There's no two ways about it. That doesn't mean the transports have to keep going. It just means they can keep going. And when I say the moving averages upsloping rises the ultimate price that the transport could get to before the necessary pullback, there's other ways of calculating maximum moves. And without getting into the detail, you can do fib extensions, which I don't particularly like, but I know other traders do. I use another methodology where I typically will take a measurement from the moving averages, and the maximum that we've gotten away from the 20 moving average, for example, which I've liked to, and I haven't called it in a while but I like to call it home base. So the market's generally going to trend close to the 20 period moving average, or vice versa. The 20 period moving average is going to trend close to price, and when price gets too far away from the 20 moving average, that's generally a sign that it's getting overextended, whether it's on the up or the downside, and that would generally mean a short-term overbought or oversold condition, and you generally start looking for a reversal or a snapback. But as we know, the market can always go a lot higher and a lot lower than most people think. But that being said, what I like to do is I like to take like a measurement from the moving average and then find an area where we did get extended from the moving average. And when and if you can find an area where you can find over the last, and it has to be within current price, right? You can't go back to when the transports were like 2,500 and say, oh, well, here's where it went, well above the moving average or well below it. It's got to be within current price, so transports are 9,700. So, within 1,000, 1,500 points would be okay. So when you look back in time and you see how far did the transports extend from the moving average, and you can find that area where it extended the most and then pulled back, that's usually the point in which that's the most it's going to extend in the future. It's not an exact science, and it certainly can be within a margin of error, but it's a good guideline. And when you couple that with, maybe you have a cycle top or a cycle bottom, maybe you have some other technical factor, maybe you have a 7 or 10 candles up in a row, something like that. You need something else to hang your hat on aside from the moving averages alone, but that's a good guideline. It's something that you can keep in your back pocket for the future. We're not too far extended from the 20 right now, but we'll get there eventually if it continues higher. All right, so we'll wrap that up. And right now, just to reiterate, we're not really that close to what I would call an extended move. And so it's not something that I'm worried about right now. This uptrending market can certainly go higher. And if I'm off, not off, but if the cycle top extends for a few weeks and the market continues higher, for example, the transports can certainly take a run for 10,000. That's not out of the question. We'll see. Only the coming days will tell the real case. All right, going over to the gold market. Gold didn't do much today. It was down a buck and change. And you can see here, this is that bearish pattern that we were talking about over the last couple of days. And it is struggling to get up above or much above current price. So generally speaking, this is poised to go lower. Gold is in a bearish wedge pattern, and these will generally play out to the downside. And you've seen this time and time again, and they look just like this. and then the next move is generally down. And unless and until we can get above this red candle high, that would take this pattern off the table, but it doesn't take the bearishness totally off the table. Even when you look at an hourly chart, just from a shorter perspective, shorter time frame, you can see here that we're trending underneath the moving averages in the hourly chart, making a bearish pattern. I mean, this wants to go lower. It's just a matter of how much. On the hourly chart, this would only play down to, maybe about $7 or $8 on the downside from where we are now, maybe not even. But all in all, it's a weak market, and there's no trade here. That's the point. The point is it's certainly not bullish. It's down too much to be bearish. You can't short something that's been down perpetually for a couple of months, or at least 5 weeks or so. And so you just have to wait for the gold market to give us some kind of a sign or signal of a reversal. Now, while this is a bearish pattern and it typically will play out to the downside, it's not for me. I'm not going to short something that's down this much, even with a bearish pattern, because at lows, and not that this is an all-time low, but at lows on charts, recent lows, the bearish patterns have a tendency to fail, and at highs, the bullish patterns have a tendency to fail. So you don't want to be caught in that. So what I would be waiting for is a reversal. And you don't have to catch the bottom, but if we got something like, let's say the gold market bottomed, somewhere down in this neighborhood. Let's just say that for argument's sake, all right? It doesn't even matter where it is. Maybe it's here. And then we got a reversal candle, and then we put in a bullish pattern. That's something I would be looking to buy for more upside. But until and unless something like that happens, or we get a flush to the downside and a reversal signal, reversal candle, engulfing candle, high volume reversal, something like that is what we would be looking for. But I'm not looking to short a market that's been down for 5 weeks. All right, let's go over to the silver market. Same pattern on silver, only this one seems to be playing out a little bit ahead of gold, and that's a possibility. We'll see if this gold's going to follow suit, but this is certainly the same wedge pattern that seems to be starting down. Now, whether it completes on the downside or not remains to be seen. We have this tail candle that still may hold in silver. It's a long way off from where we are now. It doesn't seem like it, but in silver terms, that's a long way off. And we'll see if that holds. But again, not looking to short this, looking for a long play, if at all. And so until and unless I find something of that nature, to me, there's a no trade, and we'll just move it along. So there's really no change from the pattern that we've been discussing for a few days. Crude oil is doing pretty much what we discussed over the last few days as well. It was another up day in crude, up about 56 cents, a little over 1%. And just to reiterate, here we have an A, B, and here's the C leg in development. It's got to complete, if it's going to complete, it's considered complete above the high of the A leg. And so it's moving its way up. Nothing moves in a straight line. Takes some time, but we are headed that direction. And to me, it looks like this is an ABC. So therefore, I'm looking for 48. I think crude's going to get up to 48. It's $2 from where we are. That's a nice big move. It's not an easy trade to be long crude here looking for 48. I'm just saying what I see on the charts is 48 coming. From a technical perspective, the only thing that would take that off the table would be a daily close below this low right here. That's the only thing that in my mind would take 48 off the table. So we could see some more backing and filling in crude, a little bit of back and forth action. But as long as it stays above this low on a daily chart closing basis, then I think 48's coming. I think higher prices are coming, and I think this ABC pattern will complete to the upside. And we pretty much we flagged this one, and it was pretty easy, right? It was pretty easy to tell. When we stayed inside this green candle on a closing basis, and we put in a doji candle, which is generally a sign of a trend change or a signal of a trend change, and while I like to see them at highs and lows, it still counts for something, and it was a pretty easy trade. It was obvious. If we closed below that low, then I was going to be wrong on the ABC, and we would continue down closer to double bottom. And if this held, then it was likely an ABC pattern, and that's the way you read it. All right, let's move it along to the bond market. Bearish pattern. We had a little bit of a down day in the bond market today, down 1/3%. It never was able yet to get to the underbelly, if you will, of the up-sloping trend line. And that's a sign of weakness, and until and unless it can get above that area, this is generally going to play out to the downside. So this is building energy to go lower. The more we trade sideways in this wedge formation, the more likely it is we're going lower. This is, for the most part, the same as we talked about in gold, the same as we talked about in silver. This is a bearish pattern, and that's generally going to play out to the downside. There's not a lot else you can say about that until and unless we get above this upsloping trend line, and technically speaking, really above this red candle high that comes in at 153.15. Until we can close above there on a daily chart, then this is going to play out to the downside. So basically no new information in the bond market. Market was very, very quiet today. There's not a lot of change anywhere from yesterday. And, again, just to rehash, they're waiting on earnings season to kick off. Nobody's going to do anything material until they see what's going on, and the banks kick it off tomorrow, and that's going to be one way or the other causing some market movement. Whether it's on the upside or the downside, you're going to get markets that move, and it's not just going to be the stock market. A lot of markets will start to move. Volatility will come back into the market. But keep in mind, we're in the summer months, and they're called the summer doldrums for a reason. A lot of people are on vacation. A lot of traders are on vacation. Summer months are typically quiet. But in the summer months, and it's happened many times in the past, while things are quiet, the market kind of lulls you into a false sense of security. And in the summer, they can pull the rug out, open the trap door, whatever you want to call it. And so it is possible, but we are in the summer doldrums, so we only can take what the market gives us. That's it. There's no other option. Looking over at the dollar, slight downtick today, but no change from yesterday. Again, tested the underside, or not the underside, but the bottom portion of the trend channel. It's, wobbling here. The dollar is wobbling. It's not breaking down yet, but it's certainly not giving signs of bullish behavior either. So it's just a matter of time. It needs time, and we have to wait for the market to dictate to us what its intentions are. And right now, it's just hovering down here at these lows. And something will be a catalyst. It will make its move one way or the other, and then we'll see which way. I'll break lower, and I'll back to the drawing board, back to the calculator. If we can break a little bit higher, then we could be off to the races, and it will have carved out a bottom. But we just can't say definitively yet one way or the other. And that's it, folks. Not a lot of change from yesterday. I'm sorry about that, but it is what it is. And I'm going to wrap it there tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.